Hi, I'm Yorgos Alagiannis. I teach finance at the Darden School, and I'd like to tell you about the third and last module of my new course in financial institutions and markets. This module is about understanding markets and understanding how markets can do best the role that they're set out to do, and talk about some new markets that have been created more recently, and also talk about some markets that were created earlier. The first case in this module is about carbon markets. We all know that the carbon markets are new and are also voluntary at this point in the US. It's a case about an Australian company where the markets there, the carbon markets there are actually mandatory in New South Wales. And what that company does, CO2 Australia, what that company does is basically lease land, plant eucalyptus, Mali eucalyptus trees that are native in southern Australia. They're very hard to kill trees, and they resist drought. Sheep are grazing underneath, so they're the greatest trees to have in this environment. And then they have a process whereby they sequester carbon and are able to verify and authenticate those carbon credits, and then essentially offer those carbon credits to their clients who need those credits to offset their excess pollution. There's a technical note that comes with this case, and that technical note lays out several frameworks. Part of this technical note talks about the Kyoto Protocol, talks about cap and trade versus taxation, so the different mechanisms that we can control pollution and global warming. There is a section that talks about understanding the investors in these markets, so carbon funds, but also understand what factors may be relevant in pricing those carbon credits. The next case is a very different case. It's about infrastructure, which is another big asset class and a very important one in many parts of the world. And this particular case actually is very close to my heart because it's in my hometown in Athens, and it's about the Athens bypass that was constructed just in time before the 2004 Olympics, that would basically allow for quite a bit of the flow of traffic between the different Olympic venues. It was a huge infrastructure project for Greece, a very important one, and what the case lays out is the framework to understand how the different parties, the private sector as well as the public, come together to share risks and also get that project done. Tries to understand what kind of investors will invest in such an infrastructure project, and also has a relatively simplified valuation exercise to understand how much value would investors get out of this project under different assumptions. Allows for some nice sensitivity analysis, and also in 2023 the project returns back to the Greek government, so the question then is there going to be any value left also for the Greek government? It opens up a lot of interesting questions about risk sharing, risk management, value, infrastructure project, what kinds of assets can be infrastructured. The next case also takes us in a different direction, and it's about new investors and new classes of investors. Although these are old investors that came back into light, these are sovereign wealth funds, and it's a case that is set in the January of 2008 when John Thain of Merrill Lynch is trying to raise capital. He's trying to raise mandatory convertible preferreds to recapitalize Merrill Lynch. And the case talks about sovereign wealth funds, what kind of investors they are, what their strategies are, their investments in the financial sector in the US during that time. And also talks about John Thain and how he tries to come to a deal with this mandatory convert. A similar deal, of course, was present in for other banks as well, as they try to recapitalize themselves with other sovereign wealth funds. But you can take a look at the different terms of the convert and argue a little bit about whether this was a good deal for Merrill Lynch or a good deal for sovereign wealth funds. The last case in that model is a relatively old case, but I think it's an extremely important one. It's a case on the privatization of Social Security in Chile and how Chile used this kind of experiment to essentially create a long-term bond market. How mandatory savings from the employees went through the AFPs, which are sort of large institutional investors that were holding this money as a sort of conduit to fund investments primarily at that time within Chile, so both on the bond side as well as on the equity side. But it's a very fascinating experiment in time where you can understand how a market is created. All these cases do come with a teaching note, again laying out some of my philosophy of how I go about teaching the cases and laying out some of the questions that I ask in advance the students to prepare.